If your Social Security anxiety has gone up in the last 6 months, you're not imagining things. Between staffing issues, long wait times, trust fund warnings, and constant headlines, there's a lot happening. And most of what you're seeing online is either panic or political spin. Today, I'm going to walk you through what's actually happening, what it means for you, and most importantly, the 5 things you should do about it this year. No politics here, just facts and a plan. If that sounds useful, think about subscribing. I do this every week. I take the noise and turn it into something you can actually act on. Let's start with what changed in 2026. There are a handful of updates this year, and most people have only heard about one or two. First, the cost of living adjustment. Every year, Social Security applies what's called a COLA, cost of living adjustment, based on inflation. For 2026, that adjustment is 2.8%, slightly higher than last year's 2.5%. For the average retiree, that's roughly $50 to $60 more per month, putting the average benefit a little over $2,000 per month. Here's the catch. That increase exists because prices went up, and Medicare Part B premiums, which are usually deducted directly from your Social Security check, also tend to rise. So your real spendable increase is smaller than the headline number. You got a raise because everything costs more. That's the COLA trade-off. Second, full retirement age is now fully phased in. If you were born in 1960 or later, your full retirement age is now 67. That change came from a law passed back in 1983, and it's now complete. Why does this matter? Because if you claim at 62, you're looking at about a 30% permanent reduction in your benefit. That's not a small haircut. That's nearly a third of your income, gone for life. If your full benefit is $2,000 at age 67, claiming early puts you closer to $1,400. Third, the earnings test threshold increased. If you're collecting Social Security before retirement age and still working, there's a limit on how much you can earn before benefits are temporarily reduced. If you claim Social Security before full retirement age and you're still working, there's something called the earnings test. And when people hear that the Social Security Administration can withhold their benefits, they assume the worst. They think that that money is just gone, but it's not. Here's how it actually works. In 2026, if you're collecting Social Security early and you earn more than $24,480 from work, the Social Security Administration will withhold $1 for every $2 you earn above that limit. So if you earn $10,000 over the limit, about $5,000 of your benefits are held back for the year. Now, fast forward to the year when you actually reach full retirement age. There, the rules loosen considerably. The threshold jumps to about $65,520, and the reduction drops to just $1 for every $3 you earn above that. Much more forgiving, but here's what I really want you to know. That withheld money is not lost. It's deferred. And here's exactly what that means. When you claim Social Security early, your monthly benefit is reduced because you started before your full retirement age. That's the standard early claiming adjustment. But if the earnings test determines that some of your benefits need to be withheld, let's say the $1 for $2 formula calculates that $3,000 should be held back, the SSA doesn't shave a little off of every check. Instead, they withhold whole months of payments until that amount is satisfied. So if your monthly benefit is $1,000, they simply skip sending you 3 checks. Those skipped months are what matter. because the SSA keeps track of every month that you were not paid. And at full retirement age, they go back and say, if she didn't get paid for those months, we shouldn't count them as if she did. They slide your effective start date forward by those withheld months. And a later start date means a higher monthly benefit permanently. So the $1 for $2 formula is the calculation. The withheld months are the mechanism. And the full retirement age adjustment is the correction. It's one continuous system, and at the end of it, the reduction that shrank your check early on gets partially unwound for every month you were never actually paid. So it's not a penalty, it's a correction. Now, does that mean it's a perfect wash? No, not necessarily. You lost the use of that money in the short term, and whether you fully recoup it depends on your individual situation, including how long you live. That's a conversation worth having with a fee-only fiduciary advisor who can run your specific numbers. But the fear that the government is simply keeping your money, that's one we can put to rest right now. The real question is not, will I lose money? The question is, does claiming early make sense given what I'm still earning? And that answer looks very different depending on where you are in your work life, which is exactly what we're going to talk about next. Fourth, the taxable wage base increased. In 2026, Social Security taxes apply to the first $184,500 of your income. Anything above that is not taxed for Social Security. This mostly affects higher earners, but it's also a big part of the long-term policy conversation around how to fund the system going forward. Fifth, and this is the big one, some people haven't even heard about yet. There's a brand new senior tax deduction. The One Big Beautiful Bill that passed in July of 2025 created a new $6,000 deduction for anyone age 65 and older. If you're married, filing jointly, and both spouses qualify, that's up to $12,000. This is on top of your standard deduction and on top of the existing additional deduction for being over 65. So for a single filer over 65, you could now deduct up to $23,750 before you pay $1 in federal income tax. Now, here's the fine print. It phases out if your modified adjusted gross income exceeds $75,000 for a single filer or $150,000 for a married couple, and it's temporary. It expires after 2028, but for the next 3 tax years, this is real money. The Council of Economic Advisors estimates it will benefit about 34 million seniors, with an average increase in after-tax income of $670 per person. And I know what some of you are thinking. Didn't the campaign promise say no taxes on Social Security? Yes, this isn't that. Social Security is still taxable under the same rules as before. This deduction doesn't change that formula. What it does is reduce your overall taxable income, which can indirectly reduce or even eliminate the tax you owe on your benefits, depending on your total income. Sixth, and this connects directly to a video I've already done, the ACA subsidy cliff is back. The enhanced health insurance subsidies that were in place from 2021 through 2025 expired. If you're retiring before 65 and relying on the ACA marketplace for health insurance, this changes your math significantly. Go watch my video on ACA subsidies versus Roth conversions if you haven't already. The link is in the description. Now let's talk about the Social Security Administration itself. This is where most of the fear is coming from. Here's the reality. The Social Security Administration has been dealing with staffing shortages and increased demand for years. That's led to longer phone wait times, delays in processing applications, slower resolution of issues. But here's the important distinction. This affects service, not your benefit. The Social Security check is calculated using a fixed formula based on your 35 highest earning years, your claiming age, the cost of living adjustments, and that formula has not changed. No agency can decide to reduce your benefit. That would require an act of Congress. So yes, it may be harder to get help, but that's very different from your benefit being at risk. Now, have you been wondering what 2033 actually means for the trust fund? You've probably seen headlines about Social Security running out in the year 2033. Let's translate that. Social Security is funded primarily by payroll taxes, 6.2% from you, 6.2% from your employer. For years, the system collected more than it paid out, building up reserves in the trust fund. Now, as more people retire, and these are banner years for boomers retiring, it's paying out more than it takes in. That trust fund is projected to be depleted around 2033 to 2035. But here's the key. Depleted does not mean zero. Payroll taxes will still be coming in. Right now, they're projected to cover about 77% of scheduled benefits. So the worst case scenario, the worst case, if nothing changes, is about 23% reduction, not elimination. Now, will Congress do nothing? Historically, Congress has stepped in to fund shortfalls. So it's unlikely that Congress will sit idly by and do nothing to fix this problem. A similar situation happened leading up to the Social Security Amendment of 1983, and Congress passed legislative reforms to fund the shortfall. This means the system isn't going to disappear overnight. What it also means is that there will likely be some changes. Here are the 5 things that you should do this year. Number 1, create your Social Security account if you haven't already done so. Set up your account at ssa.gov. This gives you direct access to your earnings history, your benefit estimate, and your official statement. And it reduces the risk of fraud. While you're there, check your earnings record. Errors are rare, but they do happen. Number 2, know your full retirement age and think carefully before claiming early. Every year you delay increases your benefit. From full retirement age to 70, it grows about 8% per year. That's one of the most reliable returns you'll find anywhere. I'm not saying never claim early. Sometimes there are legitimate reasons to claim early, but don't do it because you're afraid the system is going to fail. That's a permanent decision based on a temporary and, quite frankly, unfounded fear. Number 3, understand how your benefits will be taxed. Taxes on Social Security catch a lot of people off guard. Depending on your total income, up to 85% of your benefit may be taxable. That makes income planning, withdrawals, Roth conversions, timing incredibly important. This is where small adjustments can make a big difference over time. Number 4, build a bridge income strategy. If you're retiring before full retirement age, you need a plan for the gap. That might include savings withdrawals, part-time work, consulting, other income sources. The mistake most people make is focusing only on the total number and not the sequence. Which accounts do you draw from first? When do you claim Social Security? how do you manage your income year to year? That sequencing matters just as much as how much you've saved. Number 5, don't make permanent decisions based on temporary fear. This might be the most important thing I say today. Claiming Social Security early because you're afraid the system is collapsing, that's a permanent decision that will affect your whole life based on a temporary emotion. Working 5 extra years because you're scared instead of doing the math, that's time you don't get back. The people who will navigate the next decade best are not the ones who panicked or who hid their head in the sand. They're the ones who planned. They stayed informed, they adjusted when things changed, and they didn't let headlines make their decisions for them. This is retirement design. Here's the thing I keep coming back to. Social Security is one piece of a much larger design. It's part of your prosperity pillar, the financial clarity that gives you the freedom to build a retirement around purpose and play. And the decisions you make about Social Security don't happen in isolation. They affect your taxes, your health care costs, your Roth conversion strategy, your estate plan, and maybe, most importantly, when and how you actually get to start living the life you've been building toward. That's what this channel is all about, not just the numbers, the design. If this was helpful, I'd love to hear from you. What's the Social Security question that keeps you up at night? What are you most confused about or worried about? Drop it in the comments, and your question just might become the next video. And if you haven't already, take the quiz. How ready are you for retirement? I have a retirement readiness scorecard quiz in the description below. See you in the next one.